Hey, welcome to the Financial Security Planning channel. It's Eric Powers. I'm a certified financial planner, and today we will talk about 6 different investment approaches. One of the more commonly used strategies is buy and hold, and this is actually a passive investment strategy where somebody will buy and hold securities for a long period of time through the different market cycles and through volatility. So on the onset, an investor will select initial investments. They'll determine what it is that they want to own, why they want to own it, and then they simply plan to hold it. Now that doesn't necessarily mean that they set it and forget it. It means that they may make a couple changes along the way on a regular basis. Now, buy and hold is on the far end of the spectrum from market timing. 2 completely different strategies, and those are pretty much the bookends. A fundamentally weighted strategy is one that's really based upon one or more financial metrics such as the book value, cash flow, revenues of a company, or sales or dividends. Oftentimes, this is done by individual stock pickers or somebody who's indexing. Momentum investing is sort of as it sounds, where somebody, an investor, is really seeking to follow the momentum of a market or a segment. Really, it's a system of buying stocks or other securities that have had high returns over the past 3 to 12 months, but then also at the same time selling those that have had poor returns over that same period. So this kind of portfolio really requires regular involvement and frequent trades. Somebody's in there quite a bit, so you have to watch for trading costs. Market prices may be affected by certain anomalies that seem to be correlated. So momentum investors will think, let's trade based upon calendar effects. There's the January bump or U.S. presidential cycles, that kind of thing. They may buy or sell based upon the momentum. So another method is value investing. And think about Warren Buffett. This is the guy who has made this famous, value investing. And basically what he did or what he does is he looks for bargains. He's doing bargain investing. He's looking for companies that are undervalued. He's looking for strong long-term prospects and ones that really require some time and research to analyze if they're a good value. Charting is another approach. And investors who use charting believe that price acts in a predictable pattern and that there's actually opportunity in the margin, meaning that most investors are not operating in the margin. So there's work to be done. There's profit to be made in the margin. And these investors will often use what are called candle charts to predict what's going to happen next and trade based upon those factors, including price movements and trading volumes and short sales. Market timing is on the far other end of the spectrum from buy and hold. And the way that this works is that investors believe that there are turns in the market that can be predicted through commonly available information. By using this information, they're able to evaluate whether the market is overvalued or undervalued based upon and analyzing a few things, like the number of stocks that are overvalued, or the number of stocks that are undervalued, or dividend growth, or dividend discount. So there are a number of different things that they'll use to be able to predict what's high, what's low, when to time the market. The difficulty with timing the market is that you have to make 2 decisions correctly. You have to be able to determine when to buy and when to sell. If you're interested to connect with us or learn more about the financial planning that we do, you'll find links and contact information in the description section. Or you can request a free strategy call. I hope you found this video helpful, and don't forget to hit the subscribe to the channel button or to hit the like button. I hope you'll join me for the next video. See you then.